What is a company? Put it simple. A company is a contract, under which the partners agree to participate in an economic activity, which covers the different types of business, like industrial projects, commercial startup, financial institution, real estate, or agriculture business, and any other type of economic activity, operating the business under a trade name followed by the legal type of the company, aiming at one goal: making profit. The partner contribute to the company by providing a share of capital or work. However, the contribution cannot be the person's reputation or influence. On the other hand, the business owners agree in the memorandum of association to divide between themselves the profit or loss resulting from the business operation. A company can take one of the following types. The first type is joint liability, a business where the partners are responsible together, in all their personal money and wealth, for the obligations and debts of the firm. The second type is limited liability, a company where the partners are only liable to what they have invested in the business capital, which means that their personal wealth is immune from the company debts. The third type is simple partnership, an enterprise owned by two categories of local partners. The first is a fully liable partner, who runs and operates the business, and personally liable for the company's obligations, in all his money. The second category is the sleeping or silent partner, who is only accountable to his shares and investment in the business capital, which means that the silent or sleeping partner is not liable in his personal money for the corporate debt. The fourth type is public joint stock, a business entity open to the public investment, with a capital divided into shares, tradable and equal in value. The shareholder owns a stock in the business, equal to his investment in the company capital. This allows the shareholder to trade his stocks by selling them to the public, without affecting the company existence. Shareholders are not liable for the company's debts, except to the extent of their shares' value. The fourth type is private shareholding company, which is not publicly listed, as the capital of the company is privately owned by the partners, who can invest in all the shares of the business. This was it for now, but remember, a company must have at least one local owner, holding a minimum of 51% of the share capital of the business, except for the joint liability and simple partnership companies, where the business is fully owned by UAE nationals. On the other hand, a business owned by the state and a free zone company are both excluded from the jurisdiction.
A holding company is a company that owns other companies' outstanding stock. The term usually refers to a company that does not produce goods or services itself. Rather, its purpose is to own shares of other companies to form a corporate group. Holding companies allow the reduction of risk for the owners and can allow the ownership and control of a number of different companies. In the United States, 80% or more of stock, in voting and value, must be owned before tax consolidation benefits such as tax-free dividends can be claimed. That is, if Company A owns 80% or more of the stock of Company B, Company A will not pay taxes on dividends paid by Company B to its stockholders, as the payment of dividends from B to A is essentially Company A transferring cash from one company to the other. Any other shareholders of Company B will pay the usual taxes on dividends, as they are legitimate and ordinary dividends to these shareholders. Sometimes a company intended to be a pure holding company identifies itself as such by adding holding or holdings to its name.